Hello, I'm Dr. O, and I would like to welcome you back to the second module of Global Financial Markets and Assets. In the previous module, I outlined the topics and the organization of this course, as well as the investment management specialization, which this course is a part of. One thing you probably heard me say in the last module is that asset allocation is about finding the right mix of assets for a given investor. This requires, on one hand, understanding of the needs and the constraints of the investor, and we will devote an entire future course to this topic later on. On the other hand, it also requires an understanding of the economic environment, the financial markets, and the financial instruments available to the investor. So in this module, we focus on this. My goal in this module is to familiarize you with the institutional features of financial markets. We will look at the wide range of financial instruments available and also understand the roles played by various participants in these markets. Basically, in this module, I hope you will get to see the big picture of the entire financial system and how it comes together. Global markets have grown dramatically over the last 30-40 years. Several new market economies have emerged. There is greater globalization and integration of markets. It is now much easier for capital to flow across borders. There have been incredible advances in technology and financial innovation, leading to the introduction of new products such as ETFs, indexation, and several others. And despite the recent financial crisis, the value of the world's financial assets, that is the total value of global stock and debt outstanding, was a staggering $225 trillion at the end of 2012. And every day we hear about financial markets and their performance in the news. It feels like our fortunes are indexed to financial markets. But let's just stop for a minute. Why do we need financial markets? What role do they really serve? Peter Bernstein, a famous American financial historian and economist, once said, "Financial markets are a kind of time machine that allows selling investors to compress the future into the present and buying investors to stretch the present into the future." I like this quote a lot because it's a great way of summarizing what financial markets do. Think about it. Compress the future into the present and stretch the present into the future. So what does this mean? What do financial markets do? Well, what they do is help direct the flow of savings and investment in the economy from the suppliers of capital to the users of capital. This facilitates the allocation and deployment of scarce resources across time and space in the economy. On one hand, they enable individuals like you and me to save for retirement, afford to buy homes, or finance our education. On the other hand, they help entrepreneurs fund their businesses, grow their businesses, and develop new products and technologies. Capital markets also enable, for example, state and local governments to use the proceeds from issuing municipal bonds to construct roads, schools, and other public facilities. Financial markets make all of this possible. Let me give you an example that illustrates all the different functions that financial markets provide in an economy. Let's consider the entrepreneur Fred. Fred has just developed a design for a new truck that extracts rocks from a quarry far better than any existing trucks. Manufacturing this new design of trucks, however, requires an intricate assembly line with very highly specialized labor and capital. So he needs to obtain highly specialized labor, and he needs capital. Now, it would be very, very costly to try to pay his workers and suppliers with barter exchange. Thankfully, we do not need to transact in barter exchange anymore. The financial system, which also includes money in the form of currency and checks, provides a medium for exchange. It provides a mechanism to clear and settle payments and facilitate transactions so that Fred can pay his workers and get the highly specialized labor he needs. Production also requires capital. Fred needs financing for the plants and machinery, etc. Now, even if Fred had the savings, he might not want to put all of his savings into this one risky investment. He might want to keep his savings for some unexpected future event that might happen in the future. Moreover, he may be reluctant to tie up all of his savings in this one truck project which might or might not yield any profits for a long time. So his distaste for risk and desire for liquidity leave him in need of a mechanism that will provide him with the liquidity he needs and with the ability to diversify and share risk with other investors in order to start his project. So he turns to financial markets to find the investors who will fund his project. To obtain the outside funding he needs, however, potential investors who are willing to put money into Fred's business will of course require some information about the truck design, about Fred's ability to implement the design, and whether or not there is sufficient demand for better quality trucks in the first place. In other words, investors will need to assess the future prospects of this project and come up with a valuation for Fred's business. Now, finally, to finance Fred's idea, these investors must also have the confidence that Fred will not steal the funds or run the plant poorly or misrepresent his profits. In other words, the financial contracts that they will get in exchange for financing Fred's project must have the right governance features to provide this confidence. This little example highlights several functions that a financial system provides. The mix of different financial contracts, price discovery, diversification of risk. So let me summarize once again what financial markets do. They basically help facilitate transactions, smooth consumption over time and space, allow pooling of resources and risk, aggregate diverse information to facilitate price discovery, and deal with agency problems that are caused by information asymmetry. Now we have this backdrop of the various roles of financial markets. We start out in this module with a look at different financial instruments and asset classes. New financial instruments aren't created simply because someone on Wall Street thinks that it would be fun to introduce another instrument with more bells and whistles. The demand for new instruments is driven by the needs of borrowers and investors based on their financing needs, investment objectives, or regulatory constraints, or maybe tax considerations. So we'll talk about financial instruments first, and then after we have looked at these instruments, we will finish this module with a discussion of various participants in the market and their roles in financial markets. So let's have fun.